All right. Good morning, everybody. Seems like everything's running backwards today. Come on. Waiting on Zoom, waiting on everything. One of the things on the docket today is a lot of ECB. All right, there it goes. Weird how long it took for everything to load today. Ah, well, anyways. So a lot of times we start this by going to Finance Juice. Um, it's not the only thing out there. There is a free email that you can get every day from Bloomberg. It's called Five Things You Need to Know. For the fact that it's free, it's still pretty good. You don't need to have a subscription or an account with Bloomberg to get that. If you go to their website, they've got a place where you can just give them your email and they'll send you that every morning. Most of the time, for me, it seems like they're talking about things I already knew about, but sometimes there's a little something in there that I didn't see coming. And it's more on the equity side of things. Say Ford has an investors event scheduled, and I don't keep track of every single company and the different events that they have. Something like that might be mentioned in the email, and I find that a nice heads up. Or say when there was a big crypto convention or a big pot convention, it's often in there. So it's a good read. It's a short read, very quick, very brief, and that's what it's designed to be. If you are not getting that morning briefing, you got to kind of ask yourself, why not? Right? Because it's free and it's got really good information in it. Another one would be Morning Brew. That's kind of a newer aggregate news, but it's also free and it also is very detailed. It's not as short as Bloomberg's Five Things You Need to Know. In fact, it seems to get longer and longer every day, but it is uniform in its structure. And if you know what you're looking for, you just skip past the stuff, right? Like I don't tend to read a lot about the crypto side of things, but so Morning Brew, it's free. You can get that emailed to you, and then Five Things You Need to Know from Bloomberg, get that emailed to you. That's a good way to start your day because we're really just trying to identify where any, I don't want to use the word threat, but any change in sentiment could creep into that market during the day. Bank of England stuff today. Looks like getting errors on YouTube. Weird. I'm gonna keep going. I can replace YouTube's video with the Zoom video. Bank of England, a lot of things going on over there. Rate cuts. You're not rate cuts, so they would love a rate cut. Rate hikes, and they're looking, pretty big compared to what they've been used to. So a whole lot of hand wringing over there. They're talking about how impactful that is going to be to a lot of homeowners over there because apparently over in England, a lot of the interest rate on a home loan is a variable rate. So if rates go up or rates go down, you feel it immediately. You guys can imagine, if you suddenly are having to pay 9% on your home loan instead of a locked in, like, fixed rate that we have over here, that'd be a hell of a crunch. And that's Kind of a lot of what their discussion has been this morning. There's a Bank of England press conference happening right now, 7:30. In the U.S., we've got more jobs data. Later on today, Miser is going to be speaking. ECB Elderson is going to be speaking. And then we have additional auctions. So 8:30, 10:30, 11, 11:30, and then anything from Fed speakers. Now, when it comes to Fed speakers, yesterday when I was doing my midday, kind of my briefing for the middle of the day, we had not yet broke out of that range. And what I wrote in my briefing was pretty simple. Is putting it right about 11 o'clock. So we were somewhere right in there. So we're going to stay in this range for the rest of the day unless some news comes out that kicks us out of that range and or one of the speakers come out and says something that gets us out of that range. Otherwise, we're just going to hold the line, set your alerts, go do something else and wait to see if we break out of this thing. Oh boy, did we break out of that thing. Right? And it was um, I believe it was Dally. I'd have to check my notes to see, but it was a speaker. There was no more econ. There was no drive in the market until she went out there, started chipping her teeth, and gave us that push. So, that's the benefit of calling that timeout in the middle of the day to reevaluate market conditions, break the day down into at least thirds. Right, that's three different zones within the trading day. Reevaluate what's going on out there. Look at the bigger picture. Looking at the volume today compared to the volume of, say, the last week at this time of day, we're right about in line with yesterday. Seems like we're a little light compared with Tuesday. Nothing really extreme standing out, right? It's not, it just seems like we're still a little light. Okay, we're a little light, right? Coming in at around 79,000 when we can see 100,000 last Thursday, last Friday. We are still above the previous week's high. We're holding above that daily pivot. So far, it's a missed daily pivot to MDP. That's a strategy worth learning if you don't know it yet. It can be used for day trading, swing trading, just about any kind of trading you want. MDP, missed daily pivots. So we haven't hit it yet. Still an untouched. Right now, the market is still sitting with inside of yesterday's range, although we did try to inside day breakout earlier, just didn't stick yet. Now that we've left the range that we've been holding in since Friday, the expectation is that we stay outside of that range. So we do not want to break back down inside of the previous week's range. That's going to be our line in the sand, 41.44. We can, get a little weak up there, maybe stop the advancement from here, and all of that would be considered fine. But if we break back down inside of the previous week, uh, that's not going to be fine. And we're very likely going to hit the bottom edge of that range that we've been looking at, which would be around 40.80. It's also very close to the ADR full on the downside. So right now the benchmark 41.44. The expectation is that we are going to leave yesterday's range with a topside breakout. So that's the base case argument right now, is more advancement to the upside. Of course, we got econ this morning, and that can shut all that down. But after consolidating for 3 days and expanding out of it yesterday, the expectation now is that the expansion continues to get us into a new leg. Take it out here to the daily chart for a moment. Think about, you know, pause a consolidation, you get an impulse, a leg up. Pause a consolidation, you're looking for an impulse or the new leg up. Looking at how far away we are from the 10, there's still room to move before we need to pause again. So we could easily see another one, maybe 1.25% move away from that 10 period moving average. There is a 20 period over our head that definitely needs to be marked out, because if we continue that advance to the upside, we're very likely going to hit that moving average. On Thinkorswim, you can plot that moving average from the higher time frame into your lower time frame. Yeah, that's an SMA. We need the EMA. All right. It's 40.83, give or take. Let's see. 40.83 and a half. That's where the 200 EMA is at on the daily chart. So in that move to the upside this morning, if we break outside of our own Globex high this morning and continue that advancement, there is a 200 period EMA at 41.83 and a half. I've got it at 41.84, but it's close enough. All right, so that is our argument that we are going to make a topside breakout. There's always three things that we can do. We can maintain the range, expand to the upside, or expand to the downside. If the base case argument is an expansion to the upside, then 41.87 would be the ADR half, 42.24, 42.25, that would be the ADR full. If we don't make that upside move, then the next argument is that we stay range bound. And range bound would be all of yesterday, from the lowest point of yesterday to the highest point of yesterday, which is a very large range from 40.90 all the way up to 41.70. May be worth just breaking that down into quadrants or zones like we usually do, right? They would all be a part of one single range, but we can turn that range into multiple zones or quadrants, each with their own pivot points and trading opportunities inside of it. So with that in mind, I would do our own Globex low to yesterday's high. Then from our own Globex low to um, the cash open of yesterday, that gets us down to 41.15. And then from the cash open of yesterday to the Globex low of yesterday, and that would get us down to 41.85. That would give you three different quadrants or zones to focus on. Now we can have the third argument. The third would be that we actually break below the low of yesterday. It is possible, but that would be the least likely scenario, and it would be the one that would be the most obvious. Because if we're going to go down and break it underneath yesterday's low, it won't be subtle, right? It's not going to sneak up on you. It would take a significant amount of negative market out there to do such a thing. So we're either going to maintain this range or get that topside breakout. That's the more likely outcome. The volume profile. We are outside the box. We seem to be moving farther away from the box. Generally speaking, when we are at the bottom, we expect to go to the top. When we're at the top, we expect to go to the bottom. When we're outside, we expect to get back inside. So the fact that we are outside of it and continuing to move farther away from it says a lot. It takes a lot of push to do that. There is some volume right around our area, 4160. If we are to continue to fade off a little bit, we're likely to find that volume. Then it gets really shallow and it doesn't start to pick back up again until 4120. So while the previous week's high looks like a strong pivot point, it is in a shallow area, right? So um, we wouldn't put a lot of validity to that. The weekly pivot point does line up with, some growing volume. But if we break that range that we had been in for the last 3 days to the downside, that 4080, there is a very large shallow zone all the way down to the point of control at 3950. We're likely to move through that zone really fast. So, if it is that kind of day and we do break the low of that range, it's going to get very ugly very fast. There's no expectation that we're going to do that, by the way, but we know and learn by now, don't say things like, oh, well, price can't do that. Yes, it can. Price can do whatever it wants. So looking at price here with the volume profile, mapping out a 5 by 5, 4080 is still a definitive line in the sand. It's very easy to see. It's very clear. If we break that, it's going to get really ugly out there. Right now, that 4150, it matters. We broke this range that we've been in for 3 days now. And now that we've finally broke it, we've started that advancement. It needs to stick. If we wanted to stay there for 5 days and just base or range, it would have been fine. There was no rush. Nobody was pushing this market. But now that it's already started the advancement to continue after that range, it has to keep going. It can't stall now and come back in. We've had some very extreme moves in the other markets. Yesterday, the dollar was a part of that fuel or propellant that really galvanized us in the ES and the NASDAQ. The dollar had topped out, began to roll over, and it was after that very extreme push when it started to dump, and that's when we really started to take off. Right? And so it was a part of that confirmation yesterday. Where do you get the trust to jump on and run that move to the upside, if not from looking at all these other markets, right? And seeing what's going on out there. Craziness in the 10-year yesterday. I mean, it was just getting a little ridiculous, honestly. But things seems to have calmed down a little bit. We're looking at yesterday's high. Want to continue to focus on yesterday's high with the 10-year. You know, it doesn't. You could do the 10. You could do the 30. Pick one. Doesn't really matter that bad. You can see we're flirting with that 4-period daily moving average. It's that cyan line. Looking for a 4-period crossover. There'd be a surge indicator or a surge signal. The 210 yield curve continues to be something we hear frequently about in the news. It is getting worse. And the 3-month, 2-year curve, nasty, getting worse. That sell off in Bitcoin last night was a little bit of a shocker. We continue to use Bitcoin as a gauge for risk on, risk off sentiment. And it seemed like global risk just threw up their hands and said, forget it, I'm done. And that was a pretty wild move. But it held the trend line and it has re familiarized itself with the VWAP. So it's back to that. Get another run in gold. So, after that double bottom, nice expansion, it seems to be continuing without too much of a hiccup. Main deal at this point is going to be the high, that 1805, the high of this range. We are inside day breakout from yesterday, but it was a narrow range from yesterday, and we've almost doubled that, right? We've almost taken that range and did another one. Continue to watch gold. It's supposed to be a hedge against inflation. So seeing it bid up or not kind of gives a clearer picture of where other people's expectations of inflation are at. Again, that move in the dollar, even this morning, it's woke up with a vengeance. The dollar and the bonds open earlier than the rest of the markets. We need the dollar to work with the S&P and the NASDAQ, not against it. So we want to continue to see the dollar fade off. These exaggerated moves to the upside put weight on our market. You can see this morning the ES and the NASDAQ with that sharp move lower coincides with the trend line breakover and the hard run in the dollar this morning to the upside. Oil is very close to getting below $90. That is a bit of a shocker, but it's still a good thing for the rest of the market. When they've been using oil uh, as a part of their demand destruction, when we see it off like this and at its lows, not putting pressure on our market, it gives our market the buoyness or the freedom to move to the upside without that counterweight against it. So holding the lows, making new lows, basing and consolidating without exaggerated moves to the upside are all good for our market when we're looking at that oil. Want to see VWAP get below $23 today. Uh, Called it yesterday that we would get below it, and we just didn't make it, right? Like bounced off of that thing with a vengeance. Sometimes it's easier just to go back and reread what I had on my notes for the VIX. So my notes from yesterday, VIX futures dropped below 24 and our benchmark is 26, so we're not expecting volatility to be a weight against the S&P. If we drop below 22, it's very likely that we break that 3-day range. Watch the VIX closely. If they begin to drop lower today, it may send bullish flows across asset classes. That's what I wrote around 11. And right after I wrote it, we got that strong liquidation break, that hard drop lower. We didn't get to the benchmark that I had set, but uh, we've seen that flow across the asset classes in that liquidation break lower. So we want to continue to see this thing make new lows. Right, getting down to 23 yesterday was fine, but if we're going to see this rally continue in the S&P and the NASDAQ, then we want to get below that $23 mark. We are at a low in the VIX that generally would be a place to buy. When you think about the kind of market that we've been in, we know that volatility is not done yet. It's not going away. There's still a lot of uncertainty out there, a lot of things that can go wrong. The VIX is likely to spike again when it's at the lows. It's just a good time to buy some volatility. Now, we're not at the lowest lows. but we are near a pivot point. You could look to start grabbing a couple of contracts, say between 22 and 20. Just keep in mind the VIX really hasn't been as good of a hedge as it normally would be. So we're not really focusing too much on it as a hedge. We're just looking at, when volatility is cheap, pick some up. The problem is if you're going to trade VIX, you're going to need to do it in a single leg, like just straight up buy a call or sell some puts and buy a call and get those calls near the money, at the money, in the money. Don't try to get some cheap stuff far out of the money. Very much like an insurance policy. If you get the cheapest policy you can afford, it's going to cover the least amount, right? And at some point, it becomes worthless. You're just spending money on a policy that is never going to give you anything in return. So since we're not really using this as a hedge, we're thinking about it more of as a trade and buying things when they're cheap. If you get some far out of the money stuff like a 32, 34, 36, sure, we might get back to that level, but you won't make anything from that. This thing has a drag to it, and when you can't trade the VIX, right? I know that always throws everybody off. You can't trade this. There is no shares to buy. You can't own it. And for any argument of, well, yeah, well, I can trade the options. Sure, there are options here, but these options go to the VIX futures. They don't go to that VIX chart that we were just looking at. So if you're looking at, say, the September options, these September options go to the September futures. And right now, the September futures are sitting at 25.34, not 22. You see the difference there. So this is your at the money for September, not this. I know it's confusing. Either way, VIX is cheap. Wouldn't be a bad idea to buy some, but you basically have to spend money and get the ones that are a little pricey, that are in the money. And if you're not willing to spend that, I get it, right? Because, it's cost. Don't try to go out of the money and think, well, I'll just get this cheap stuff way out here because it's not going to do you any good. If you do want to finance those at the money calls, just sell some puts and then use the credit from the put sales to help you finance the calls at the money or in the money. And for those puts, you could sell, say, the 20, maybe the 22s. Now you can see we've gone lower than 22, but we haven't maintained lower than 22. We don't seem to stay down there for very long. So if you sold a 22 put and you ended up underwater for a little bit, the idea would be that you'd very likely see a spike back up and you'd be able to get out of those 22 puts that you sold because we're not likely to stay below 22 for long, right? All right, so you can see that strong move in the bonds, the strong move up in the dollar, and the immediate response in the S&P and the NASDAQ back below VWAP, back towards the big orange line, which is the Globex open of yesterday, of last night. And the VIX is responding with that upward push. If we get above 24 today, then we're very likely going to get back in that box today. All right, we're looking at TradingView S&P 500 pre-market change percent. This alone isn't very useful. It isn't very helpful at this point. We need to filter it down a little bit. We don't need 500 names. Try to get it around 100. 100 is hard to do because of, this is market cap, and so it'll bounce from like 115 to 87. Just get it close, right? Just trying to knock it down from that 500 name. That's better, but now we still got a lot of gray. The color scheme is just a simple reaction to how far price has moved. It's sitting at whole numbers at 3 to -3. We want to use decimal points. 3/10 will make it more responsive quicker. So we do that, and now we've got this. The size of these boxes are a reflection of the market cap. Looking at the FANG names are the biggest boxes on the screen. Amazon, Tesla, Nvidia, Apple, Google, Microsoft, Meta. They stand out well, and as they should. They're just easy to see. Right? A lot of market cap. They're big. We want to look at them in their totality, the group. How are they doing all together? Nothing from Microsoft, very little out of Apple. Google, Amazon, and Tesla looking pretty good. Tesla is more advanced than the rest of them by over 100%, right? It's up 1.5%. Amazon's at 63, Google's at 55. Even Meta's dragging its feet this morning, a little better than Apple, but not by much. So some positive flows. And I'm really pointing these out because right now, tech is the only thing saving this thing. This rally was tech. And if we lose it, we're losing this rally. If we look at the bullish bears in the after hours, yesterday afternoon, I posted the sector grids. These are weekly charts with a 50-period moving average. And if you go through the list, the risk on sectors, they're not looking too bad, right? Consumer discretionary, technology, and finance. But finance was the one that was most concerning. This is the financial, the weekly chart. We're inside week. It didn't participate in that big breakout rally, and it's still underneath that candle from last week. We're also underneath the 50, whether it's the 50 EMA or the SMA, we're still underneath it. We lose the financials, that's it. Whereas with tech, we hit the 50 last week, closed there, got through it. We're now above it. Sure, we got that other 50 over our head, but you threw one, you're pretty much through with the other one. I would expect to see some tangle there when we get around the 150 half, but we need tech, right? And we lose that, that's it. Consumer discretionary hit it yesterday. It hit that 50. So it's going to very likely resolve itself today. And if this is like the backup to tech, and this is where Tesla is. So if we lose Tesla, we lose consumer discretionary, we lose this, then we're really leaning only on tech. So from the S&P, we'll flip over to the NASDAQ 100. We don't need a filter because it's already got 100 names. Just want to give it a color scheme adjustment, make it a little more responsive. Again, the big boxes stand out by market cap. When it comes to the NASDAQ, out of 100 names, it's really just the top 10 names. But if you look at the top 20 names in the NASDAQ by weight, they make up more than all of the rest combined, right? They are the NASDAQ, those top 20 names. Even with the color scheme adjustment, there's a lot of flatness this morning. We see that chips are not looking really good. bag to Nvidia. It's a little positive. Qualcomm, MU. But then on the other side of that, Texas Instruments, AMD, AVG or AVGO, Broadcom. So they're not working together. We don't have a group. We're not getting that, that parity assistance. We're looking for a high correlation coefficient, and it's just not there. One of my benchmarks for the kind of day that we're going to have is how many names in the S&P and in the NASDAQ are up by at least a half of a percent or a 1% move. That high correlation coefficient. So in the pre-market, if you run a scan for something like the NASDAQ and you ask, well, how many names in the NASDAQ have moved at least a half of a percent? 15. That's not even remotely close to being enough. So we had that break yesterday to the upside. We're not seeing that follow through this morning. Just keep in mind what I said a few minutes ago, that the monsters of tech are the only thing running this show. And if we lose those, we lose it all. So one of the things that we need to happen is for the rest of the market to come up and give some assistance to those monsters of tech. Or that we got to just keep our eye on those and see if they can continue to carry this market. So your numbers are going to be off on something like this if we're not getting that assistance from anywhere else. There's a phrase that says a rising tide lifts all boats. I'm sure you've heard that. Well, if the rising tide is tech, if it's the monsters of tech, and all boats are the rest of the market, so far, it's not bringing up the rest of the market with it. We're not seeing that follow through, which calls into question this rally that we're getting. And it would make me want to stress caution to anybody still wanting to go long right now. Approach with caution. If we're only looking at the candles, we're in a full on rally to the upside, and there's no reason not to go long if we're only looking at candles on the chart. The S&P, the Qs, all those tech names that are set up and primed for an entry to an upside move, the chart says take the trade. But the Fed made it very clear that they're not going to be done raising rates until they see definitive proof that inflation is going down. And their benchmark target is to be around 3.5 or 4% by the end of the year. The reason that everybody said that the Fed just called a pivot is because we're going to be very close to that number. And so they believe that when we get to 3.5 or 4%, that the Fed is going to say, oh, yeah, we're done raising rates. We're going to hold it here and see how it plays out for a while. So the market seen that as positive and as a dovish tone and pounced and started buying all this. But if we don't see the abatement of inflation the way that the Fed says that they want to see it, then they're going to continue to raise rates beyond that benchmark 3.5, 4%. Because they said no matter what it takes, they're going to get inflation down. And that they're not going to stop until they see clear and definitive proof that it is going down. So no matter how much technical analysis you do looking at the candles and looking at the charts and trying to game theory where we're going to be, you can't game theory the economic data required to convince the Fed that inflation is abating. So are we going to retest the lows if the inflation readings don't show a clear decline? We're going back down because the Fed is going to raise that benchmark rate even farther away. They might start calling for 4.25, 4.5, or 5% before they stop raising rates. Trade what you have. The charts say go long, go long. Run your hedges and be prepared to have to cut those trades short. And one way that we approach that is to just trade with a smaller position size, right? There's people that say, well, I've got cash on the sidelines. I want to get engaged. I'm getting in. Great, fine. get in at a smaller size so that if new econ data comes out that shows that inflation is not abating and the Fed starts making statements and implying that they're going to start aiming for 4.5, 5, and we start moving to the downside, your trade can be cut with a minimum of loss, and or you can just lock your profits in, right? Kind of get out early. Keep the position sizes small if you want to participate at all in a swing. This isn't the kind of market to get greedy and start sizing up with a large part of your account. Looking at how many names are up this morning in the pre-market in the S&P and the NASDAQ, it is a dismal number. This is slightly up, barely up at all, not enough to even make me consider that this bullish move this morning is going to start off right away. Now, it could come in later in the morning, certainly, and we've got enough econ on deck that it could galvanize us and get that continuation. But I would say continue to watch the NY and something like the KRE because it's a nice ETF for financials, and that your breadth numbers are likely to be off if the only thing running is the market monsters of tech. You don't need 90 names out of 100 to be going up. You only need 8 out of 100. The fangs. So what I got for you guys. Be careful. Be safe. It is my day to stream in the bullish bears futures. I'll be there at around 9:15.